Imagine buying a $1,000 TV. You swipe your credit card. The purchase takes 2 seconds. It feels effortless. You take the TV home, watch movies, enjoy the upgrade, and then life happens. A few unexpected expenses appear. You decide not to pay the full credit card bill, just the minimum payment. A month passes, then another, then another. Years later, you may still be paying for that same TV, not because it was expensive, but because debt has a strange way of growing when it is left alone. This is the story of how a small piece of plastic changed America, how credit cards transformed spending, created enormous wealth for banks, and helped build one of the largest consumer debt systems in history. Credit cards were not created to trap people in debt, at least not at first. In the 1950s, carrying cash was still normal across America. If you wanted to buy something, you paid immediately. Then companies introduced a new idea. What if trusted customers could buy now and pay later? The concept spread quickly. People loved the convenience. Restaurants accepted it. Hotels accepted it. Stores accepted it. Soon, banks realized something important. The more people used credit, the more money flowed through the financial system. A simple payment tool was becoming something much bigger. What began as convenience was slowly turning into a new way of life, and America was about to embrace it faster than anyone imagined. By the 1970s and 1980s, credit cards were everywhere. Banks launched massive advertising campaigns. The message was simple: freedom, convenience, opportunity. Why wait months to buy something when you could have it today? Millions of Americans signed up. Credit limits grew larger. Applications arrived in mailboxes across the country. The system felt amazing. Families could handle emergencies. Students could buy what they needed. Consumers could enjoy a better lifestyle immediately. But there was a catch. The easier money became to access, the easier it became to spend. People were no longer limited by the cash in their wallet. They were limited by something far less visible: their future income. At first, banks earned money from transaction fees, but they soon discovered something far more profitable: interest. If customers paid their balance in full every month, banks made some money. But if customers carried debt month after month, banks earned much more. Suddenly, a credit card was no longer just a payment tool. It was a debt machine. And the longer debt remained unpaid, the more profitable it became. This changed the entire business. Banks didn't just want people using credit cards. They wanted people carrying balances, because every month of unpaid debt generated new interest. And that interest was quietly becoming one of the most profitable businesses in America. The real gold mine had finally been discovered. Then came one of the most powerful features in modern finance: the minimum payment. Every month, credit card statements showed a small number. Pay this amount, and your account stays in good standing. For many people, it felt like a solution. Money was tight. Bills were piling up. The minimum payment seemed manageable. But there was a hidden problem. Most of that payment often went toward interest, not the original debt. The balance shrank very slowly. Sometimes it barely moved at all. A purchase that seemed affordable could remain on a statement for years. Consumers felt like they were making progress, but many were running on a financial treadmill, moving constantly, yet never getting very far. As credit card use exploded, so did bank profits. Every swipe generated fees. Every missed payment generated penalties. Every unpaid balance generated interest. The system was incredibly powerful, because banks were not lending money once. They were lending the same money repeatedly while collecting interest along the way. Soon, credit cards became one of the most profitable products in modern banking. Year after year, billions of dollars flowed into financial institutions. Meanwhile, many consumers believed they were simply buying convenience. But convenience had a cost. The easier it became to borrow, the easier it became to accumulate debt. And by the early 2000s, America was carrying more consumer debt than ever before in its history. Today, consumer debt in America is measured in trillions of dollars. Millions of people carry credit card balances every month. Some use credit cards responsibly. Others struggle to keep up. A single emergency can quickly become a financial crisis. A medical bill, a car repair, job loss, unexpected expenses force many households to rely on borrowed money. The problem is not always spending. Sometimes it is survival. When debt grows faster than income, people fall behind. Interest compounds. Balances increase. Financial stress rises. And what began as a temporary solution becomes a long-term burden. For millions of Americans, debt is no longer a tool. It has become a permanent part of everyday life. But the story is not ending. It is evolving. Today, new financial products are appearing everywhere. Buy now, pay later, digital wallets, instant financing. The technology looks different, but the idea is familiar. Spend now, pay later. The future of consumer finance is becoming faster, easier, and more invisible. And that creates a new question. If borrowing becomes effortless, will debt become even harder to escape? Credit cards did not take over America because people loved debt. They took over because people loved convenience. The lesson is simple. Debt can be a useful tool, but when convenience hides the true cost, borrowing can quietly control your future, long before you realize it. History has the answers. You just have to know where to look.